Number one rule of investing that even idiots understand.
I've been investing in sports cards for 18 months.
How to invest so that they can get filled.
Those investments that I think will make 10%.
At its core, investing is an incremental game. You build a portfolio a bit by bit rather than all at once. In this video, we'll look at how you can invest $1,000 and get the most bang for your buck. Investing allows you to significantly grow your money over time thanks to the power of compound returns. Compounding can be called the eighth wonder of the world.
We wanted them all to be compounding, in effect, be compounding machines. That's why people gave us capital. That's why we put our own capital.
Thanks to the power of compounding, a single penny can grow into millions of dollars. Nevertheless, for the vast majority of investors looking to put $1,000 to work, the best investment has to be simple, low risk, and cheap with respect to fees. If we want a decent return, then the risk must be lowered through diversifying the investment, and the best option for that are low or no fee funds.
Whoa, hold on. You made $2,000 in a couple days? Yep. Oh my God. You gotta teach me how to invest.
Number 1. Invest $1,000 in a single stock.
Let me create wealth for you.
Now we are going to look at some investments that you wouldn't recommend to your grandparents. These require a higher risk tolerance and a lot more research, but they also offer high potential returns for your $1,000. This is for the type of person who relishes in yelling, "I'm all in," while playing poker. $1,000 is enough to make a single stock purchase through an online brokerage reasonable. You do not lose some money in the transaction itself, but the right stock can return many times the transaction costs. There were several points in the last 5 years where an investment in Facebook, Apple, Netflix, or Google would double or triple your $1,000. The catch is that you would have to time the market, and you have to have realized those gains. That said, researching a stock and putting $1,000 into it can work out. Of course, it can also end up with you losing your money or making a smaller return ETF investments containing the same stock as part of the mix. Number 2. Invest $1,000 in an ETF or index fund.
What exactly is an index fund? An index fund is really just a group of investments that you could put your money into, and then you own a percentage of the entire thing. Here's an example. Imagine if I own 1,000 apartment buildings and they're each worth $1,000. I go to you and I say, I will sell you one of my buildings for $1,000. That would almost be like the equivalent of you going and buying one stock of one individual company. But the problem here is that now you only have one apartment building or one investment, and what happens if that investment doesn't do very well? Or maybe that one company you invested in has a CEO who loves to talk on Twitter and he ends up saying some stupid stuff that gets him in trouble with the SEC, and that company doesn't do very well in the short term. How do you prevent something like this? Well, here's the solution to this. Imagine in my previous example where I gave you a scenario where instead of investing $1,000 and you buy one of my 1,000 apartment buildings, imagine if you could invest $1,000 and then you get 0.1% of everything that I own, so you're a small percentage owner in all of my apartment buildings. This way you get an averaged return based off everything that I own. This is basically an index fund.
Exchange-traded funds and index funds are an excellent way to invest with a relatively small amount of money. These funds also have the advantage of being very transparent investments. You can learn all you need to know about a particular ETF or index fund in a few paragraphs, including its holdings, any commissions, and the expense ratio. Index funds are essentially a passive forward market investment through the major indices, while ETF can offer more choice to customize a portfolio. With $1,000, you can pile together ETF with different risk profiles. For example, you can split the money into $250 in a higher risk, growth-oriented ETF, $250 into a dividend ETF, and put the remaining $500 into a bond ETF. Or you can reverse that mix or even put it all into the growth ETF. It all depends on your time horizon and your risk tolerance. Number 3. Invest $1,000 in a target date fund.
Now, target date funds move money from riskier investments such as stocks to more conservative alternatives such as bonds closer to an investor's retirement age.
Target date funds offer similar diversity to ETF, but these require less effort than picking your own ETF. A target date fund may have a higher expense ratio than your basic ETF, but in return, you won't have to worry as much about allocating your money or rebalancing the portfolio over time. Target date funds are further down the spectrum of being actively managed, and active management costs more in fees. Number 4. Invest $1,000 with a Roboadvisor.
Would you trust something called a Roboadvisor? As our John Defterios found out in the UAE, plenty of people actually would.
With $1,000 to invest, the fees that come with active management can be hard to swallow, especially given that performance often lags passive index or ETF options. That said, robo-advisors like Betterment, Acorns, and Asset Builder have hit the market offering active management at lower expense ratios than prices offered by human fund managers. This has prompted traditional advisors like Fidelity Investments and Charles Schwab to jump on the AI bandwagon for some of their offerings. You can get the benefits of active management, particularly more frequent rebalancing of the portfolio during market events, without having to pay the traditional price. Number 5. Invest $1,000 in low-risk debt instruments. The funds mentioned above generally carry a higher risk and return profile than investments in debt instruments. If your main goal is preserving $1,000 rather than growing it, then debt investments may be your best choice. Treasury securities, certificates of deposit, and saving bonds are not the most exciting ways to invest $1,000. They do, however, have the benefit of very low risk and a modest return. There are bond offerings direct from companies that offer much higher interest rates, as well as bond ETFs, but these both require a bit more research and a lot more risk than simply putting the $1,000 into a US Treasury bond. On top of the security, Treasury bond income is exempt from state and local taxes, although it is not exactly a windfall of tax savings given the modest rate of return. Number 7. Trade options and Forex with $1,000. There is a fairly big gap between can and should when it comes to $1,000 investments. $1,000 can be used to open an online option or Forex trading account, and yes, these accounts offer ways to leverage that money up to make large returns in a short time. However, just because you can doesn't mean you should. Of all the investments we've looked at, Forex and/or other options trading offers the most risk and the highest probability of being able to lose all your money in a short period of time. There are, of course, many people who can take $1,000 and, pulling on their experience with different trading strategies, produce solid returns while controlling their risks. Some people have probably lucked out and tripled their money on a single currency trade based on a hunch. That said, many of these traders most likely lost $1,000 or more just learning their craft though. At least try out these types of trading through simulators before putting your hard-earned cash at risk. So, the bottom line is, although it is not a large sum of money, $1,000 is well worth investing. With many of the options we looked at, particularly ETFs, sums as small as $50 or even $20 are worth investing on a regular basis. It bears repeating that investing is an incremental game. You probably won't go from $1,000 to independently wealthy with a single investment. Instead, an investment of $1,000 can help you in the direction of financial security and broaden your financial education as a side benefit. And that's it, guys. Thanks for watching the video, and don't forget to like and subscribe. Till next time.